Today's video is on Appley, the synthetic covered call fund that tracks Apple. It yields a very high dividend, and I'm not sure of the dividend yet because those details haven't been disclosed. But as you can see, we're making about $106,000 in dividends per year, and that number has not changed. I bought about 3,500 of Appley, as you can see in the portfolio below. Appley, 3,500 here. So I only bought 3,500. I'm waiting to buy more. I'm waiting for the fund to dip some, as Apple's stock price is somewhat elevated. And I don't know the exact dividend yield. Some people are saying that it could be in the 20% range. One gentleman commented in my comment section that you can look at the implied volatility as a way of deriving their yield. So if you just look at the implied volatility for, let's say, a Tesla, in his example, he was saying that if the implied volatility is 60, then the dividend yield would be 60, or the distribution, however you want to look at it, or however you want to phrase it. And he said, therefore, if Apple's volatility is around in the mid-20s, then the dividend should be in the mid-20s. I just thought that was a very simple way of looking at it, but that would make perfect sense. I mean, I do understand when I sell options personally that some of these yields are exorbitantly high. So like Riot, I just sold a put on that, by the way, the other day, 50% premium on Riot. So these options premiums are definitely possible. And I just prefer, obviously, concentrating more money in a Tesla or an Appley that's high quality, unlike a Riot, which is Bitcoin. It's a Bitcoin miner. So here's Riot, by the way. You want to come down here and see Riot. See $5.31, but the strike price is 10. So 10, $5. We made over 50% premium in Riot. Our cost basis is 5. And so the stock is above 10, and our cost basis is way lower than the market price, and we got 50% just for clicking a mouse. Well, so that just proves that options can go for really high premiums when they're volatile, and Tesla is volatile, Apple is pretty volatile. So, if Apple's volatility is in the 20s, then the dividend could be in the 20s. Once again, I really appreciate my subscribers for reaching out in the comment section and educating me on these funds. And so don't know the exact yield, but maybe check out the implied volatility. I can tell you what the fund does. If you go to their website, you'll see here that they purchase call options at the money, and they sell put options at the money. And this allows them to pay for their call option. If they sell the put option, that pays for the call option. That's how they track the stock price of Apple, is they buy the call at the money, again, and they sell the put at the money. For the put options, you should be aware that that these contracts provide exposure to the full extent of any share price losses experienced by Apple. So when you sell puts, you have to get assigned to the security, and once you get assigned, the stock could continue to drop and you could lose all of that position. Whereas when you buy a call and this position drops, you can only lose what you put up in the call. So calls are less risky than selling puts from that perspective. However, if you have to track the underlying somehow, so you buy the call at the money and you sell the put at the money. That's how you track the price. And they do it 6 months to 1 year out, so it should be low volatility options. If you do 1 month options, the shorter you are that you have in options, the more volatile. So the longer the duration, the less volatile. So that's nice. It'll keep the security relatively sideways and muted in volatility. Because I know a lot of people want to put a lot of money in this fund. And, that way, if you do that, you have to be aware of big swings. And if they use these further out options, that helps shield and dampen some of that volatility, which is nice when you have large positions. And then, most importantly, they sell call options out of the money. That's where they get their premiums. They sell these out of the money, and they do them 5 to 15% out so that you get some participation in the stock if it goes higher. Yes, the upside is capped, and you won't participate in a full move from Apple or a full move from Tesla, but you're still going to get 5 to 15% of that move, and that's going to be for 1 month, so they can always re-roll the calls next month, and so they'll reset the strike prices and get new premiums. But for now, you're going to get that hefty premium that they're giving you through these options. They're going to give you that dividend monthly plus a little bit of stock participation, a stock upside, 5 to 15% upside. And then they have U.S. Treasuries as collateral and as a little bit of extra income on the side. So it's very interesting fun. I like how they replicate the movement of Apple through buying the call option and selling the put, and then with low volatility with the extended duration options. And then I like how they then sell the options out of the money, so that's how they get the yield, but they do so in a way that you can still get some upside in the position, 5 to 15% upside. So I think this is a very fascinating fund. We can go here and check out more on the specifics in this email one of the guys sent me from yieldmax today. I appreciate him very much. So I'm clicking on the link sent to me, and it'll show the strike prices of Appley. And it shows here the strike prices and the holdings are about, they are 165, 165, and 172. So there's a 165 call, as they said they would do, and they have a 165 put that they sold, as they said they would do, and then they have a 172 call out of the money. See this call, this 172 call, it's out of the money, 165 and 165. Those were at the money. So if you remember those prices and you go back into the chart of Apple, we'll go in through Appley here, APLY, Appley, and we're going to go to the chart of Apple, and I want you to just see how the 172 strike price, because there was 165 and 172, correct? 165 and 172. How those strike prices correspond with the resistance on the chart for Apple. So Appley, we're on its snapshot. There's no dividend information. There's no chart. There's no information available. I wish I could give that to you, but I don't have that. They are showing that it's up after hours. I don't know if that's a glitch or not. So back to the stock at hand, Apple, which Appley tracks. So here we go. Apple, if we go to its chart, you'll see that 172 is the old resistance. And so I think that's what yieldmax is doing. They're putting the strike prices strategically at this point, 172. So 172, as you can see, we're about 166 on the chart. We have a few points upside before our upside is capped at 172. So we can make all this. I think that's interesting. 172 again is the resistance out of the money. That's about 4 or 5% upside from here, as they said in the prospectus. From 165 to 172, if you go put that in a calculator, 165 to 172, it's 4%. 165, 172. The calls there on the prospectus where it says 172.5. So that's where you get the 4.5% return, which if you round that, it's about 5. So it's what the prospectus says. So I think that's pretty interesting. Now you can hedge this position out with APD, AAPD, if you're nervous about your Appley position. Especially if you have a larger amount and you want to be able to sleep at night. That's what I do with OARC. We have 15,000 now in OARC. Yes, we said we are going to keep it at about 10, but I've elevated it to 15 because I just, I think it's a fund, so it's a little bit safer than the stocks, and 15 is about my max weighting for the other funds. And I got a question about that, by the way, in the comment section about how would I do the allocations of my funds with 150 grand. Well, let's just, for math's sake, keep that allocation scenario at 100 grand. Okay, 100 grand is what you start off with in a portfolio. How would you allocate that 100 grand? I would put it all in the S&P. Yes, the Schwab D's of the world, the Jeppies, but I would basically put 10,000 in each of these funds that I have up top. Cornerstone, I wouldn't look. I want to recommend Cornerstone to everybody, but Cornerstone has a 20% dividend, and it's great, but you have to play it right. You have to time it. When the rights offering comes, that's when you sell, and then you have to buy back after the rights offering, and so it's a little bit more complicated than other funds. To me, it's easier because they telegraph when to buy and sell it. But for other people, that's they don't have as much time to follow it. So then look at these other funds below Cornerstone. Cornerstone, by the way, is a 4-star fund, both of them. So, but look at USA. Forget RYLD. I don't like that fund as much. It's the Russell though. That's why I keep it. It's the Russell 2000. I have to have that exposure somehow. So look at these funds: USA, RYLD, JEPI, BDJ, not OARC, but GOF, RIV, BST, SHI, PTY, CSQ, all these raw. As you go below raw, though, these ratings start getting lower. EOS, that's a 4 to 5 star ranked fund. I would put 10K, not in AMSA. No, that's a low ranked fund. The ones I just mentioned to you, EOS, and everything above CSQ, PTY, SHI, just not OARC, because we're not sure on OARC yet, and RYLD. It's not my favorite fund. It's the Russell. Put 10K in each of those funds. You can't go wrong. On 100,000, 10% in each. You're never supposed to put more than 20% in one name if you do allocations. And that's a rule of thumb when you're allocating your funds. Never more than 20% in one position. I have all my money in Cornerstone. Yes, I have 400 grand in it, because I really believe in it, and it is the S&P and NASDAQ. So if you're going to have a portfolio, I don't see why you can't put the entire portfolio in one name. In fact, here are 2 names, because it is the S&P and NASDAQ. So, but these other funds I mentioned to you, most of them were indexed funds that follow either the S&P or NASDAQ. So you can't go wrong if you just tie your whole 100,000 to the indexes, the S&P or the NASDAQ or even the Russell, and then break them down into equal amounts, 10,000 each, just to keep everything equal weighted. And that's how I would use the 100,000. If it's 150,000, just change those percentages some. Schwab D and VU and those other funds are great, but they don't provide qualifying income to the banks. That's the main reason why I don't like them. I like to collect these dividends because I can take loans out on these dividends. Unlike with regular stocks, the dividends don't qualify to banks. They don't like ups and downs of stocks. They need steady dividends. So that's why I don't like Schwab D and VU. Plus, if you look at a Morningstar test of what these funds earned, they beat Schwab D and VU. Schwab D made almost 40,000 over the last 10 years, according to Morningstar, less than 40,000, whereas these other funds made 40 or more. Cornerstone made 55,000. So that's how I would do my allocations, to answer your question. So back to this fund, Appley, this covered call fund. That's what I did with the shorts. I didn't hedge with APD, but you can. OARC, I have my short with SARK, SARK, and it's been a losing trade ever since I made this trade. SARK down $270, but it helps me sleep at night because I have a considerable amount in OARC. So, and plus this dividend from OARC is by far beating what I'm losing in SARK. Anyway, Appley, we'll figure out the true dividend when the details are released. For now, we're going to go with the idea that they're probably going to be in the 20% range. I'm going to add to that fund on any dips. Hedge it with APD if you're feeling uncomfortable. And as far as your allocations go, keep everything weighted to the indexes, as I mentioned. And that's why I like keeping Appley and Tesla, by the way, in my portfolio, because they're large parts of the indexes. So that kind of stock exposure is good for my portfolio. It helps with performance with the market. And last but not least, if we're ever wrong on these funds and they drop in price or they cut the dividends, all you have to do is wait a certain amount of time, and then the dividends pay back the investment. So that's the main allure of any of these dividend funds of mine, is that I just simply wait for time to do its job, and these dividend funds cash flow themselves. So again, OARC 40% dividend, that's going to be in a couple of years, 3 years, and I've already paid back the position. With Appley, 20%, let's say, dividend in 5 years, that's 100%, so that pays back the position. We're up 15% for the year. NASDAQ is up 16, Dow's up 2, S&P is up 8, so we're beating the S&P and Dow. We're behind by a percentage point in the NASDAQ. We're losing some in our shorts. Some performance is being affected because of our short positions. I told you guys, when you hedge against a bull market, it's a losing proposition. But everyone's so scared, and I have a little bit of margin leverage on, so I just prevent black swan events from destroying my portfolio by keeping some of these short positions on, these put positions. I have some out until May. As you can see, I'm losing pretty good on those. I have about 1,000 in losses in those, at least. So, but I won't keep those on in the next month because it looks like the banking crisis has been averted. As the bank's reports, earnings reports today confirmed that the sector is still healthy and going strong. So, for the way I covered it, please let me know in the comment section. Please give me share your strategies with me on how you're playing Appley, and I'll talk to you soon. Share your strategies with me on how you're playing Appley. Talk to you soon. Thanks.